hello again. Welcome to the Marc Oslar Retirement Experience. Hope your summer's going well. And we are here each and every week to sit down and talk about a topic that maybe you need to deal with, and that is what's going to happen with you and retirement. You're coming up on it. You see some of your friends retire, your coworkers retire, and you wonder, how's this going to go with me? And you've not really sat down and actually put pen to paper and done a little math on it. Well, Marc will do that for you, and that's why we want to introduce you to Marc Oslar here. And Marc, how are you doing today?
I'm doing great, Randy. It's been a pretty hot summer so far, and we've had dealt with some drought here, and that's just one of those things that just happens during the summer. But let's be positive. Let's talk about the great financial news we're going to talk about today. I know you got some great stuff for me, Randy.
Absolutely. And we're going to deal with one of the hot topics out there, and that's the recent release of the Micron report. But let's dig in here just a little bit, because as you look at market history, if you take a look at some of the stuff that's going on right now, A, we're in the summer, B, we're in a midterm election year, and C, we just nominated a new Fed chair. And anytime those three things even individually happens, usually the market goes down. You put all three of them together, you would think the market would go down, but it hasn't happened. And one of the things that has happened, I'm watching Fox Business News the other night, and Charles Payne was on, and he was saying, this Micron report, if this thing comes favorably, this means that AI has more room to run, and I think it's going to cancel out all that negative headlines for the summer. Who knows if he's right? I don't know. But how do we, as people looking at the market and getting ready for retirement, look at these two diametrically opposed headlines? It's going to go down. It's going to go up. How do we deal with this, Marc?
It's just so funny you bring this up. If you look at semiconductors as a whole, they've been going through the roof. Mm-hmm. Am I right?
Yeah.
I mean, you've just been seeing them up and up and up. And is there more room for it to grow? Yeah, it looks like there's more room for it to grow. But at the same time, you keep hearing reports that there's going to be a pullback. Mm-hmm. And the question is this, are you at this stage in life where you're just trying to make as much money as possible? Are you a youngster? Or are you older, but you don't mind all the risk? I mean, that's a question you have to ask yourself. I myself, for retirement planning, when people come to see me and talk to me at the office, one of the things we dive into is what type of risk and return are we looking for? And obviously, you're talking about Micron. You're talking about, I think you even spoke of SpaceX before as well.
Yeah.
We'll talk about that for a minute. But
sure.
The question is, do you want to buy IPOs? Do you want to do these things? Or are you looking to actually get fundamental retirement planning? These are two totally different points of view. And these are the things we like to discuss here.
Well, one of the things about this whole AI, they call it a bubble. They think it's a bubble. I don't know if it's a bubble, but they keep comparing it to the internet and talking about the dot-com bubble. And I was, we all lived through that in the late 90s and moving to 2000, and it just kind of busted. But a lot of people know, when you look back at that, some of those companies that people were investing in weren't really brick and mortar companies that were making widgets. They were just names. And this AI thing, they are actually making stuff. And Micron is making stuff for other people. And so there seems to be a little bit of difference here. It seems like that there's a little more depth to this one. I don't know if it's got a long way to run or not. I worry about the fact that it's going to run out of gas at some point, and the market could really suffer. I mean, that's, as a person, who's 65 years old, I got a 401k in that market. I worry about stuff like that.
Sure, absolutely. I mean, there's also ETFs out there that are geared towards semiconductors as well. So these are the things that we bring up. An ETF is an exchange-traded fund, works like an index, can be traded sort of like during the day like a stock could be traded. It's not like you have to wait till the end of the day like a mutual fund. So that's another way maybe the person can diversify a bit, but at the same time, it's volatile. You're also talking about volatility, and you're talking about AI, Palantir. That's another one. So you're talking about a stock that could be very volatile. Do you want that in retirement? Right? That's another question that we bring up. Do you want those stocks? Well, here's the thing. This is the coolest thing, Randy. If you decide that you want to use our acronym for how we help people retire, which is PIG, Preservation, Income, and Growth, and you take your preservation tactics and you build in the proper income planning with preservation tactics, then we could pick out all the growth models we want for that G, right? And that's the cool thing. So nothing's off the table here. That's why we have these conversations. Do you want some of that volatility? Well, Yeah. I mean, when you come in, I'll show you different ETFs. We'll talk about individual stocks. We'll talk about what we do with our planning strategies. We'll discuss things like structured notes that a lot of folks might not understand those, and I'll explain those in more detail later on. But essentially, we have access to things that you and the general public don't have access to as financial advisors, and we want to help as much as possible. So there's a lot of things that we can discuss here at the office. And yeah, just breaking down cap space, companies, stock, all that stuff, sure. But what we'll also do? We'll run a financial report for you. We'll run a financial report for you so we can diagnose where you're at and where you want to go.
So, Mark, as you sit down and do the analysis for somebody comes in and you look at their 401k, you look at their holdings and things like that, and maybe they're hot to buy some of this AI stock. And I want to get into NVIDIA. I want to get into Amazon. I want to get into Meta. I want to do all that. When you look at their 401k and they've got an index fund, chances are they're probably in them already, aren't they? In some way, shape, or form. Maybe they're in them 2 or 3 times and they don't even know it. They just don't own the individual stock like what they're talking about.
Yeah, I just ran a Morningstar report for a client, and we just went over all the information, and there was overlap, and and you just don't even realize it. It's because of how you're investing the money. You really want to see where the overlap is. It can be discovered in the stock intersection report, where we break it down through the indexes, the ETFs, the mutual funds, to see how the stock breakdown happens, what's your top 7 positions, what are your top 20 positions with regards to correlation, which is things moving in the same direction, and do you want such a positive correlation in retirement? Because really what that means is if you have too high of a degree of correlation, then if the market corrects, you can correct exactly like the market. So what we want to do is reduce some of that risk. And these are the things we want to affect in your lives in a positive manner. Show you how you can retire, how you can have the income of retirement, put in the right preservation tactics, and grow the rest of the portfolio.
This is what you can learn from a meeting with Mark, and we talk about it every week, a no-cost, no-obligation look at your retirement. You want to know what's going on inside your 401k. You want to know if there's a lot of tech in there or what sectors that are in. I mean, we just push money to that 401k and hope it goes up. I mean, that's really what it's been for the last 20, 30 years, right? Okay, so now you're going to use that money. Where do you want that money? How do you want it to perform? How much risk do you want? Let's get all that out on the table and have those questions answered for you. It's a no-cost, no-obligation meeting with Mark and the team, and all you have to do is go to moretoretire.com. moretoretire.com. Just spell that right out. There's a place for you to put some information in there, and Mark and the team will reach out to you and say, okay, what are you worried about? How can we help? Or you can just bypass all that and just give them a call. It's 984-300-1984. 984-300-1984. Don't put off that retirement conversation anymore. Let's sit down and actually put pen to paper and see where you're at. If there's any gaps in there, what if there was a surprise at age 73 and you didn't know about it? Let's know now. 984-300-1984. Well, it's been kind of a cool summer here with the World Cup. I know some people that are just really into it. They're watching every single game. But it's been fun to see some of the people from overseas who have come here and they drank Boston Dry and they did all sorts of fun stuff. So while they're not watching the games, what are they doing? They're going out to restaurants. They're going out sightseeing. And what are the cool things that they're seeing? You might be surprised. Walmart and Buc-ee's.
So we are back in Walmart. This is the biggest tourist attraction I can have as a European. It's like a museum, literally like a museum.
I just had Texas barbecue for the first time in my life. Oof, better than any moment in my life. And I am married and have 2 kids.
A little brisket will do it. The international language of love there, right there, brisket. All right, so that was a pleasant surprise. And I've been loving to see how people are enjoying the States. I think this has been kind of a fun story. But Mark, when we change this into a retirement conversation, let's talk about maybe some pleasant surprises that take place when you sit down with people. We're always wondering, oh, did I save enough money? Do I have a problem? Can I retire? But sometimes the conversation is, hey, why aren't you retired? Tell me a little bit about that.
First, let me ask you, have you been to Buc-ee's before?
I have been a number of times, and I've had the brisket. Yes, I have. Oh, yes.
Oh, yeah. I'll tell you, we stop, like if we're going to Florida or something like that from North Carolina, we'll stop in South Carolina, and it's nuts, okay? It's loud. It's chaotic.
Yep.
But I will say, even though if there's a line for the bathroom, it goes fast. I mean, it's really quick. They keep the place clean, but it's such a cool store. And, I'll get the chopped brisket sandwich. I love it.
It's good.
I even got this chicken fajita burrito. This thing was insanely good.
Oh,
it was so good. Their jerky selection is off the chain. Yeah, if you've never been to a Buc-ee's, and then let's just say you're coming from another country and you see it, you're like, whoa.
You got to go.
Now, Walmart's a different ballgame, okay?
Walking across the parking lot through the gas line is probably the most dangerous thing you'll ever do in your life.
Extremely dangerous. Hold your kids' hands.
It's pretty busy out there. All right, let's talk about pleasant surprises in your meetings. What do you got?
The greatest pleasant surprises are when I try to affect the situation where I tell a client, for example, hey, what if you have to retire early because you get laid off? Or what if you do decide you want to retire early? Why don't we start planning for that now? And then when something like that does happen, which it has happened in the past, I can look them in the eye and say, hey, guess what? You can retire.
What a great
they
thing.
Get excited.
Yeah, I love it. I mean, that is what I hope that happens for the people that sit down with you, is that the news is good. And even if it's not, even if you come in 3 years before you want to retire and Mark looks at you and say, you know what? We can get you on schedule if you just do this, make this move. That's why, Mark, isn't it good to come in a little bit early? So if there is something there, a little fly in the ointment, we can fix that before you actually get to your retirement date.
Yes, and sometimes there are folks that want to retire early and they might have to take some risk to do that. Okay? So there's some people, they don't want any risk with their income and their retirement, but there are other people that maybe you've saved a certain amount of money, but you need a certain amount of income. It depends on the gapping. You want to retire at 59 and a half because you can start drawing your IRA or your 401k. But at the same time, you can't draw Social Security yet. So the question is, what does this look like between 59 and a half to 62? What does it look like from 62 to 65? What do your expenses look like? What can we prepare for inflation? So all of these things pop up. What I do is I figure out based on the law of large numbers of what they've done. So we look at it in our first step of our process is that treetop view, and we see buckets of money. And what I want to do is see how those buckets of money work. Now, if they need to get, use some type of risk for a little bit more of a return for income and retirement, we'll start to look at structured notes. And the structured notes, basically, and I mentioned this before, it's when you allow a big bank, they call them the banks that are too large to fail. I don't call them that, but that's what they call them, okay? And basically, you let this bank borrow your money, and then they tell you the parameters of how it works. Basically, if you're looking for a yield one that has a coupon, they could be rates that are much higher than multi-year guarantee annuities, right, or CDs. And so you look at these as a way to make a little bit more of a return. Now, it has risk. You might have these things called barriers. A barrier is a way where you can protect the income and protect the money as long as it doesn't drop by a certain amount. So, for example, in one case, it might be a 30% barrier. What that means is that if that structured note says they'll pay you income for a month or quarterly, monthly or quarterly, they'll continue to pay it as long as it doesn't drop below that barrier based on how they've put that information in that prospectus, right? But at the same time, at the end of the term, as long as it's not more than that negative 30, then you get all your money back at the same time. You look at another issue. That's an example of how a structured note might work, okay? Now, we might have to use those when a person needs a higher yield or a higher amount of income. And so those are the things that we look at and we have those conversations. If you don't need it or we prepare ahead of time, we can tell you that as well. And these are the types of things that we love talking about that folks don't realize are available.
Think about all the things that you've done in your life to save money and to be successful in your purchasing. I mean, you go to Amazon Prime Day, you use coupons, you do all your computer research, you do all these things to save money in your life. When you're going into retirement, you want to go in prepared. and you want to kind of do your research and you want to kind of do your homework. That's what a meeting with Marc is to sit down and say, here are all the options out there available to me for income and for protection and for growth. And all as we talk about on this show, that's the conversation to sit down with Marc. It's a no cost, no obligation look at your retirement. Let's look at what you've done over the years to save for retirement. Let's look at what you pay per month for your regular bills. Let's look at what you want to do in retirement and what that will cost. Get it all into the meeting and start to plan for this great 20, 25, maybe 30 years of the next chapter in your life. Here's the number and here's the website, 984-300-1984. 984-300-1984, or use the website, which is more2retire.com. All right, so the numbers are in here, Marc, for last year. It's annuity sales, and they're up again. It's another new record, $464 billion. Almost a $500 billion was purchased last year in annuities. Yet if you mention that word, eyebrows go up, and people put the crosses in front of you like you're a vampire or something. I don't get it. There are a lot of feelings both ways, pro and con, on annuities. But CNBC did an interesting article and said, here's why. People view annuities as an investment, and they stack it up next to things like stocks. And they see huge stock gains, and then they see annuities not having that many gains, and they say, well, this one's bad. And that's basically it. But Marc, there is a difference. Every tool in your retirement toolbox is there for a different reason. An annuity is supposed to serve a purpose, not necessarily that shooting up Micron stock that you would buy that goes up by 80%, correct?
Yeah, I mean, first of all, I don't want somebody in my office and I talk about an annuity and they say, put them up. Come on. I mean, we don't, it's just not going to happen here. All right. Listen, the bottom line is we love to use annuities when we're looking for preservation tactics for income or maybe for, as they call, preservation growth. They can be very good tools. There have been some terrible ones that came out where the indexes didn't perform or people got in during a time when participation rates were low, maybe when interest rates were low because they're interest-sensitive products. These are things I'd love to look at for you. Premium bonuses are the highest I've ever seen them in my entire career by a landslide. And if you think you can't get out of your contract, I think there's a possibility you're wrong. And I think I'd like to have that conversation with you. Let me look at those old annuities. Let's take a look and see if you need to have a real good look at them, see if you need to change them. That's a really good conversation for us to have. Now, I do like to use annuities for these preservation tactics. It's a big part of what we do when we're looking at a portfolio. Now, I'll say this. I stacked it up on a piece of paper. I recently did a little summary of what I would like to do for a client. And really, all we did, there's three parts to it, and it was for income. And basically, 1/3 of the part was an annuity. And it was not an income rider. It was called a family endowment rider. It happens to be effectively a death benefit rider. And it has a certain percentage that it will put on the contract. And it's they'll put it in there fixed for a certain number of years. And basically, it allows a dollar-for-dollar withdrawal privileges. However, we use that particular portion of it for the withdrawal, but it has indexing that can make a lot more than the family endowment rider. But I try to base it on what they put in the contract for the family endowment rider because they say it's fixed for that period of time. And that's what gives me a little bit of that, I would say, more certainty of knowing where that money's coming from. The other 2/3, we used stuff that was not preservation tactics like annuities, okay? So we used a couple of structured notes, one with a lower yield, higher than the annuity, and then one with a much higher yield, right? Well, when you look on a piece of paper, those look so much more attractive. And what I have to explain is, look at what you're getting here. Look what the insurance companies do. They give you a lot of different ways where you can feel pretty confident that your money's not going anywhere, right? And you can pull from this money because it says it in the contract, but then at the same time, it could effectively make a lot more than that. All right. So these are the conversations we have to have and explain that if you stack it up on paper and then you're like, well, what about this? This ETF made 30% last year and the other one made 18% and so on and so forth. And you're talking about this percentage. Well, I'm just going to share this with you. If I know for certain we can get this money into your bank account, then I, as an advisor, feel better and put my head on the pillow comfortably at night, just like you. And that's where it comes in. So with annuities, yeah, we're big believers in them, and they're better in terms of rates and premium bonuses than I've ever seen in my entire career.
Well, speaking as Randy's third grade education level here again, to me, annuities are like a pizza, okay? Here's my big analogy. When you want a pizza, you can add on to a pizza. You can put on pepperoni. You can put on mushrooms. You can put on all these different things. You add on to your pizza. It costs you a little bit more. On an annuity, you can kind of do the same thing. Do you want to have some long-term care benefits on it? You can add that in. If all the money in your mutual fund all went away, would they keep paying you? No, it'd be gone. You'd have a big old goose egg, a zero. But on an annuity, the company keeps paying you. So, I mean, there are some differences here, and there are some things to look at. So if you stack NVIDIA up against an annuity, know that those aren't really good comparisons, but know that one tool is supposed to do one thing and the other tool is supposed to do something else. Let's talk through it and see which tools you need for your retirement. MoreToRetire.com is our website. And when you go there, tool around a little bit, you'll see the steps to more, and we'll talk about that today. That would be what happens when you go in for a meeting. But to sit down with Marc and actually talk through some of this specifically for you, 984-300-1984. 984-300-1984 for a no-cost, no-obligation meeting. All right, so we all have talked about it many times. The number one fear in retirement is running out of money. Everybody's afraid to run out of money. But what we're seeing is there's a shift happening right now. And people are afraid of that big market crash. They're afraid that's going to take all their money. But one thing is for certain. If you lived into your 90s, you lived 95, you lived to 100, you're probably going to need a little bit more money than if you passed on at 85. So longevity is starting to become one of the big issues of retirement. Marc, are you seeing that the people are actually afraid of living a long time more than they are afraid of the market?
Yes. We dedicate a couple of slides to that when we do a presentation, right? Mm-hmm. It's really important for us to do that because I want you to understand when you come to a workshop and we share this information, it's realistic, okay? We're talking about what's really happening. And I want people to know that we care about it, and I think you should care about it too. There are some people that say they don't care about longevity, but most of the folks that I look at out there, they've experienced some things. They've experienced some things with their parents. They've experienced some things maybe when they saw their grandparents go through some stuff. Maybe you have a parent that's living a very long life, mm-hmm. right? These are the things that we have conversations about because I want to make sure that we understand that if you're going to live a long life, we can make this money last for you. That's really important to understand. And you don't want to run out of money. Everybody gets nervous about that. Especially when you stop working. Let's say you stop working because you're disabled, or let's say you stop working because you just want to retire. There is that healthy concern from those folks that say, well, I don't have that job anymore, and now I'm working off of my money. And then you start getting nervous of what if you have to bite into that? Well, let me give you an example of how you don't have to be nervous. If you have all your money just sitting in the market and you have too much of a high degree of correlation where stocks are moving the same direction and the market corrects, and you could correct like the market in the last two recessions, 2000 to 2002 was a 49% drop. 2007 to 2009 was a 56.5% drop. And you're pulling money from that money. Where's the sense in that? Mm-hmm. That's going to put you in those positions where you could be losing money and pulling from it. I'd be nervous too. Mm-hmm. So let's do something different. Let's look at our preservation tactics. Then we'll use income for our preservation tactics, and then we can prepare for taxes and inflation. Then, if we do all that, we can grow the rest of the money effectively, and that will eliminate the concern.
You're listening to the Marc Oslar Retirement Experience, and online you can find Marc at MoreToRetire.com. If it's time to talk about your retirement, let's not put that off anymore. Don't procrastinate on that one. Let's have a meeting, sit down, and actually talk through some of the details. And I'll bet there's a whole bunch of questions that you haven't really thought too much about. They're just concerns. I worry about running out of money. Well, that's just going to bring up a whole bunch of different questions. I worry story that all of my money's in a 401k. That brings up a lot of questions. Let's get those questions answered. It's 984-300-1984. 984-300-1984. Or use the website, which is moretoretire.com. And there, Mark, you'll see the steps to retirement. So this is where people will see kind of the process that you go through. And as you just said, that treetop level is the first step in the process. And that's really kind of a gathering of information and saying, what does this look like from 50,000 feet? Tell me a little bit about the process.
Sure. So at moretoretire.com, you go to our the process tab. That's our process guide. And when we go about it, that step one is that treetop view. I call it sort of like macroeconomics. It's a big overall view of your situation, and I look at different buckets of money. I'm just trying to understand things, so I ask a lot of questions. I have a good friend of mine that used to call me question mark just because of that. So I love asking questions because I can never know too much. Now, once we know a little bit, we go to step two, which is discovering your retirement desires and dreams, right? More questions. We usually combine 1 and 2 together in one appointment. Sometimes it could take more than one appointment. It just depends how much information's there, what's going on in your life. Then, after we understand all this stuff, we're going to put together a plan for you, step 3. We're going to put together a customizable plan. You can manipulate this thing however you want. This is something that can be changed and switched, right? But once you do that, you become a client. And after that, what you're going to do is you're going to be getting ongoing support is step 5. But step 4 is also part of the process, which is effectively reviewing and going over and making changes and adjustments. Because in life, you have to be willing to ebb and flow. And that's what we do here. We are ready to make changes. We jump on things, and we're not afraid to change something in your portfolio. We want to do that to stay up with the times.
So if you don't have that yet, if you haven't sat down and had that kind of a conversation to see what it looks like, give Mark a call, and we'll do that for you at no cost. No cost or obligation to take a look at what's going on with your savings right now, with your retirement accounts, with your desires, where you are at work right now, whatever it is. Or maybe you're actually in retirement right now and you run into a little bit of a snag. Oh, that was a surprise. Okay, bring that question in. Let's talk through it. 984-300-1984 or moretoretire.com. All right, so we have found, according to the numbers, that all this business of people saving money and you got to have $1.4 million to retire, 1.8, 5 million, whatever the number is these days. Only 3% of Americans have saved $1 million or more for retirement. You've probably heard that. You might be shocked to find out only 4% of Americans have saved between $500,000 and $1 million. So how about we do this? How about we talk to the other 93% of you right now, okay? Let's talk to you who have saved $500,000 or less for retirement. Let's get into that a little bit. Coming up next on the Marc Oslar Retirement Experience.
A simple piece of paper. It's something we use every day. For the most part, it does what it's designed to do. It sits there flat on your desk as a placeholder for information. But with a couple strategic folds, suddenly your flat piece of paper becomes an airplane and flies across the room. Your 401k is kind of like that flat piece of paper. It just sits there as a placeholder for your money. Marc Oslar can show you those strategic moves to take your 401k from just sitting there to creating the income you need for retirement. Call today for a free no-obligation meeting, 984-300-1984. That's 984-300-1984. Or online at moretoretire.com.
Welcome back to the Marc Oslar Retirement Experience. Online, it is moretoretire.com. Also want to mention that if you kind of got into the show just a couple of minutes ago and you kind of like what you're hearing, this show is on our podcast as well. So if you look on iTunes or Spotify, just look up the Marc Oslar Retirement Experience, and this show will be there, and other shows will be there as well if you want to do a little homework there. That, again, on iTunes or Spotify. Okay, Mark, I mentioned that, 3% of Americans have saved $1 million or more. Only only 4% have saved $500,000 to $1 million. That means there's 93% of people out there that are going to need your help that are in this area up to $500,000. So my question to you is the planning for this group of people different, that much different, than the planning that you do for people who have $500,000 and more? And how is it different?
Sure. Well, first of all, come one, come all. Come on in. I want to meet you all. So the way we look at it is not about how much money you've saved. And we've talked about this before, because you give me these articles sometimes and I just get irritated, oh, you need to save $1.2 million to retire, right? And I'm thinking, can I get a fire and just toss that thing into the fire? It's so irritating. It has nothing to do with how much you've saved. It comes down to income. It comes down to, do you have enough income already? Do you have income planned for a certain age? Do you have a pension? I know I'm talking to people out there that are in the Fayetteville area or were, Army, military, anything like that might have some military pensions. If you already have enough income, then it really comes down to preservation tactics. Because if you only have a certain amount of money, you want to work off of that money maybe a little bit differently. Maybe you have plans for it. Maybe the way you leave it. Maybe you haven't made some long-term care provisions. It comes down to preservation at that point. And we are a little bit more conservative with people that have less than $500,000. So that is definitely something we talk about, because certainly if you're working off that sum of money, and let's say you already have the income, well, what is the intention behind that money? What are you trying to accomplish? And what can we do to help affect that in a positive way? So those are the conversations we have, Randy. So
it makes sense, because if you had $3 million and the market went down 50% and you had $1.5 million, you're probably going to be okay. But if you had $500,000 and the market went down 50% and all your money was in the market, you got $250,000. Now there's a problem. Now we get into that area of, I don't want to run out of money. So that whole idea of preservation tactics really starts to come in here. And if you have somebody who's got longevity, as we just discussed, if you have somebody whose parents maybe needed long-term care and they might be headed for that needs to be discussed. So, it seems to me that there's got to be that the person going up to $500,000 has to really drill down and have some real strategies for these things, because there's not a lot of wiggle room for mistakes here and those outside influences that might come in and take your money.
And that's the thing. Gosh, Randy, when we look back at 2007 to 2009, when the market dropped 56.5% before it took some time to come back, people were calling 401ks, 201ks. People were panicking. Do you remember those times? I don't want you to be panicked or worry, but we haven't had a market correction in 17 years.
Right.
So that's a real eye-opener, right? Do you want it to happen right before retirement or in retirement? And how can that affect your retirement portfolio, especially if you have $500,000 or less? So I want to make sure that if you do need income off of the money that you've saved that's under $500,000, that we can show you how you can do that and make sure that you're going to get that retirement income that you need. But we're going to have a real conversation about it. And I'm not going to lie to you. I'm going to be completely honest with you and tell you what you can expect. And there are going to be times where maybe you do have to take some risk. But the question is how much risk, what degree of risk. And we do love to use annuities for preservation tactics. That's one of our big things that we like to use for preservation tactics. But that's not all that we do. We do portfolio management. We use a lot of different positions. We use structured notes for income as well. It's not just annuities. So there's a lot of different things we do here. We love to run a financial report to diagnose several things about your portfolio. I was looking at one the other day that I ran, and I recognized that it had a standard deviation that was in the neighborhood of around a 10, right? Well, where's the S&P standard deviation usually at? It's usually between a 14 and a 16. And Randy loves to call the standard deviation what, Randy?
The wobble. How much does it go back and forth? Yeah.
Yes. And that bend helps us understand what kind of return and risk we're dealing with, right? So S&Ps is usually between a 14 and a 16, sometimes between a 13 and a 16, right? Well, we have a market guard model that's a pure equity model that's right around a 14 right now. So it gives you an idea that we're around the same neighborhood of the S&P 500 for standard deviation. But then our market guard pure equity model has a beta, which is a scientific risk, That's actually right around a 0.9 or a 0.91 right now, and that can change, okay? It's based on risk. But the S&P's is a 1.0, which means that we are showing a little bit less risk based on how we're allocating. But this gentleman's beta in his portfolio was a 1.01. So he was right around the S&P's risk, but he didn't have the same wobble effect as the S&P. And we're the opposite. We have the same wobble effect of the S&P with less scientific risk. So that's one of the things that we like to talk about, and that's one of the things you might notice in your portfolio management. And these are the things that we bring up because we could change that.
Yeah, it's interesting to me because as we talk about the group of people that have up to $500,000, you might be looking at yourself and say, I don't have enough money to warrant a financial advisor. That's for people who have millions of dollars. Well, as we're just discussing here, you may need this kind of help more than that person who has multi-million dollars because there's so little room for mistake. And as Marc has just told us, that you need growth and you probably are nervous about that stock market, but there are places to be in the stock market that have less risk. You don't have to be that high-flying Bitcoin hedge fund kind of a person. There are other places, and let's figure out what's right for you. Give Marc a call. Let's sit down and talk about your retirement, what you want to do, what you've done, and how it all fits together. Here's the number. Here's the website, 984-300-1984, 984-300-1984, or the website is moretoretire.com. I mean, this is a show really where we're kind of introducing you to Marc, how he helps people in retirement, his philosophy of how to develop income, how to help with preservation, how to develop growth, and the things that we need in our retirement years. And one of them is getting a handle on income while there's a lot of volatility out there. So there was an article in Kiplinger, and it talked about if the market is down or flat for an extended period of time. I mean, we have had a lost decade not that long ago where the market really didn't go up or down after 10 years. It was pretty much flat. What happens during that period of time with your withdrawals? You're getting money from your accounts. If the market goes down, that means you're taking more than you wanted. So do you pull back on that? Marc, how do you deal with a market? You're taking market money, but the market's going down. How do you survive something like that in retirement?
I'm salivating over this question here. I love this. My gosh, this is what I get up for. I get excited about this stuff because you don't have to do this. You don't have to have all your money in the market. If you want to have all your money in the market, then we probably need to talk about some preservation tactics that you really don't want an annuity. We're going to have to look at different preservation tactics, right? Mm-hmm. I brought up structured notes earlier because they do have some things built in, right? They have those barriers built in, and they have those buffers built in. Buffers, for example, a lot of times if you see a buffer, it's usually 20%, and a barrier usually 30%. There's a difference, a strategic difference. A buffer is when the bank will take the first 20% loss on your money. So if the index goes down by 25 or 30, let's say 30%, then effectively during that period of time, you'll lose 10%. The bank will take the first 20. If it's a barrier and it goes down 30% and the barrier is 30, you don't lose anything. But if it loses 35, you lose the whole thing. You lose 35%, okay? That's an example of a buffer and a barrier, but structured notes have those. But if you're directly in the market in positions directly without any kind of buffers or barriers, then you're fully exposed. And if you decide to take withdrawals while you're fully exposed like that, you can have drastic effects. We call this sequence of returns, okay? Sequence of returns is where you take the same amount of returns, let's just say a 10-year span, and they're the same returns, but we jumble up the years that you have those returns, and you're taking the same withdrawals every year. Both column A and column B, the remaining amount of money could be drastically different. Mm-hmm. And I can share that information with you. I could show you an example of what that looks like. Just come into my office and have a conversation with me. I'd be glad to share it with you. Randy, I think it's important for you to understand you don't have to back off of withdrawals. You just have to be smarter about how you place your money. Annuities are a great preservation tool, but so are structured notes as well. And then we look at how we affect the other money. So we always go by that, Rand. We talk about preservation, income, and growth. We want to make sure you have the income tactics built in with preservation, and we do have to prepare for taxes and inflation. If we do those things, then we can still have healthy growth.
So we talk about your money making money, not just peeling money off the top. And that's what we talk about using annuities and things like that. We also talk about buckets of money. You may have a market bucket that you're going to use, 5 years from now. You have a real conservative bucket that you use in the first 5 years. You have a long-term bucket that you're going to use 10 to 15 years from now. A savings account is not affected by the stock market. So if the stock market is going down, Mark, do I just go to that place, that bucket of money that's not affected by the market? Because if I got market money and the market's going down and I'm pulling, that's a double whammy. I don't want that. Is it just a matter of where I get my money from, or is it where the money is placed so it's kicking off income? I imagine it's a combination of all of it.
It's definitely a combination. I mean, I really don't want to work like that where we're using income tactics from non-preservation tools. It makes me nervous as an advisor for you and for me. And, honestly, I don't want you being mad at me when things don't work out like that. So that always is a concern. Do I have some clients that have all their money in the market? Yes, I do. But if they're asking me to build preservation tools for income, I'm certainly not going to advise to do something like that. So it's really important to understand that you don't have to do this in retirement. There are ways that we can build around this and give you the income you desire. And yeah, you don't want that double whammy. If you start losing money and you're pulling from it at the same time, it's pretty rough. Let's just say, for example, you're already starting an uphill battle. If your account goes down 30%, you have to make basically 43% to get back to square one. And if you're taking withdrawals, that'll have a drastic effect. Let's say you go down 20%, right? Well, if let's say you were taking, 4% off of that 100%, well, now if you're still trying to take that same 4%, what are you dealing with? You're dealing with taking out 5% at this point. That's going to have an effect too. So again, having these conversations and affecting your lives in a positive way to show you how you don't have to do it this way, how you can have preservation tactics built in for income, and we can grow everything else. Let's have that conversation.
Whatever you're going to do in retirement, whether it's a cross-country trip with your RV or doing a Mediterranean cruise or a Caribbean cruise or an Alaskan cruise or you're in Hawaii, whatever it is, you don't want to be out there. Turn on the TV, turn on CNN, and then all of a sudden they're going, oh, market's down 7% today. And you're like, holy cow, I got to call Mark. Yeah, you don't want to be that person. You want to know that as the market goes down, you have a strategy for that. You already built that in. You had that conversation with Mark 5 years ago, and you feel confident as you go on your merry way. Let's get you that kind of a confidence going into retirement. Sit down with Mark and let's work through this. Get a date on a calendar. 984-300-1984. 984-300-1984 or online, as always, more2retire.com. It's a no-cost, no-obligation meeting, really a conversation about your retirement. So one of the things that people will do as they just start to tiptoe into this area in their 60s and they start thinking about retirement is they'll go online and they'll start to look for things to see if I'm ready for retirement. You're going to come across a retirement calculator. There's a million of them out there. And Clark Howard, he's the watchdog guy on radio and TV, and he helps us with all our consumer issues. He got a call just recently, and a guy said, I've been using a bunch of these retirement calculators, and they're all telling me the same thing. Not enough saved, invest more with us. He says, I think that's a little fishy. Clark, what do you think of retirement calculators? And he basically said, every one of them uses a different kind of math. The algorithms are all different. It's really hard to get a consistent answer about your retirement from a retirement calculator. So what is your thought about those things? Is it a good starting tool, or is it kind of can throw us off track, give us too much confidence or not enough?
I don't know. You got me kind of guarded here. You started with Clark Howard, and I got to tell you, this is a little rough here.
Okay.
I started my career in 2001 receiving these little mailers that people will respond to. I go door knock, or I call them and say, hey, can I come by and answer your questions about these things? And it would be about life insurance, annuities, and stuff like that. So doing some insurance stuff, insurance products. And I come in there, and as soon as I mention an annuity, you'd be like, I've been listening to Clark Howard. Oh, no. Here we go.
Yeah, Clark does
Mr. Clark.
Clark likes immediate annuities. He doesn't like any other kind of. So he has one favorite, but that's about it.
That's it. So I'm okay. I'm all right. This is not about annuities. I disagree highly with Clark on that one. But
okay.
This is what it's about. There's a website called dinkytown.net. You ever hear that one, Randy?
No,
Yeah, I've known this one for over 20 years. Dinkytown.net has all kinds of financial calculators and tools.
Okay.
They're pretty neat. I'll point someone there to go look at those financial calculators if they're just kind of curious about using different ones and some components. It's something you can just go up online and look at some stuff. But truthfully, as a whole, I would say if you're looking for a financial calculator to do what a financial advisor does, it's not going to happen. Mm-hmm. And just like when people are looking to replace people with AI now, it's not going to happen, okay? You're getting information about, Charles Schwab moving more to AI for some people as opposed to working with people as well. And you hear these stories and these conversations are coming up with me, and I'm hearing about this, I'm reading about this, and I'm thinking, they can't do what a financial advisor does. We can think, with our brain, but also understand emotion. And that's really important to understand. We are compassionate here. We care about you, and we can affect your life in a positive way, one way or another, and we'll be your friend even if you don't become a client. We're glad to be a part of this community. We're in Cary, North Carolina. We're on the corner of Kildare Farm and Manor Road. We have a great address. It's 919 Kildare Farm Road. It does not get better than that. And I want to tell you, when you meet me, you get to know me, you understand what we're trying to do here at the office. Our group, our model, and our motto is to affect people's lives in a positive way. We stand by preservation, income, and growth. We'll stick to it. And as financial advisor, we can help in areas that financial calculators and AI cannot.
Well, why don't you use Mark as your retirement calculator to sit down and talk through it? Because, I've used those things. Everybody's looked in there. And, there are a lot of questions, but there are some questions that aren't there that you really can't drill down on that you can, Mark. There's no place in there that says, Mom went into long-term care and I'm worried about Alzheimer's and I'm worried about those costs. There's nothing in there about that. There's nothing in there that says, there's a difference between retiring in Raleigh and 2 hours outside of Raleigh. There's going to be a difference in cost of living. That kind of stuff just isn't in there. And to sit down and have those kind of questions, you got to sit down with Mark. And then that's going to be more of a customized look at things. Mark, you can drill down a lot more. That initial meeting where you sit down and talk about that overall treetop view, that's where this is going to happen, isn't it?
It is, and that's the point. I can work with people that have $100,000 or people that have millions of dollars. And really, to me, it doesn't matter how much money you have. It's can I help? Mm-hmm. And that's what we care about. We want you to know that that's the number one thing we care about. How do I make money? Two ways. I make commission from insurance-based products. I charge fees when I'm managing money in the market or in structured notes and things like that, and it falls on our platform, and we have a custodian. Our custodian we use is Fidelity Investments, very common, a lot of assets under management there. So what do we care about? We care about helping. So if that's what you're looking for some help, you can have some appointments with me, and I will not charge you a dime to do that. I care. Okay, and that's where we'll go. And if you don't end up doing business, no problem. We shake hands, high five, whatever it might be. I'll be here, okay? But I am looking for people that are looking for folks that need help out there. They really have to have these questions answered. That's what I'm here for.
Retirement tends to be, as you come up on it, a place that is kind of unknown. I mean, there's a whole language to it, for crying out loud. What's provisional income? What are capital gains? What are RMDs? What is IRMA? I mean, it's a whole world of stuff that we've got to learn because we're going to live there. And to have somebody who's gone through retirement time after time after time and encountered all of this stuff and can maybe look down the telescope and say, you know what's coming? Let me show you what might be coming. That's the kind of person that you want to sit down with. Give Marc a call. Here's the number, 984-300-1984. 984-300-1984. Get a date on a calendar, and let's start talking through it. You can use the website, too, more2retire.com. There's a place for you to put some information in there. Marc will reach out to you and get the conversation started. Again, 984-300-1984. That is all the time that we have this week on the Marc Oslar Retirement Experience. Remember to check us out on iTunes and Spotify for our podcast. We'll be here next week. We hope you will be too. Have a great weekend.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.